Imagine you have $100,000 sitting in your bank account, and I know some of y'all do. Leave it in savings, and a year from now, you've made about $4,000. Put it in an RV park, and a year from now, you've made about $12,000. Same 100,000, but three times the cash flow. Tonight, I'm telling you why nobody's buying RV parks and why that's about to change. So make sure you subscribe and stay until the end if you want the real tea every week. What's up, wealth builders? I'm Jael Thomas. I'm a wealth strategist, and every single Wednesday at 7:30 p.m. Eastern, I come on here and break down how regular people build real money in real estate. Real quick, guys, if you're watching this from at home, or even if you're going to watch it on the replay, I need you to drop your city in the comments below right now. I read every single comment, and I want to see where my wealth builders are watching from. If you guys also want to be part of a like-minded community, join our free Facebook group, and I'll drop that link after this Zoom. Look, guys, I met a guy and I worked with him about 3 years ago. Very smart guy. He'd been pitched on everything: apartment buildings, self-storage, mobile home parks. But RV parks felt really weird to him. It felt like vacation real estate. Like, what do I know about people with RVs? He almost walked away from a great deal. Then we sat down and ran the actual numbers together. It was a small park, about 40 pads for RVs. The price tag was about $1.2 million. The owner was charging $450 a month for each pad. Most pads were rented out year round. After paying all the costs of running the park and after paying the mortgage on it, the park was producing $50,000 a year in pure profit. Cash in pocket, y'all. But here's the thing. He didn't have $300,000 to put down, not by himself. So he called his buddy. He literally picked up the phone and said, "Look, I know this might sound crazy, but do you want to come in on a deal with me? We can both bring about 150,000 and we can split the profits. About 25 grand a year in our pockets. That's a 16% return on what we put into this. Better than anything we've ever seen in the stock market. And here's the best part. We're going to hire somebody to run this for us. Neither one of us has to lift a finger." How many of y'all would have said yes to this deal? His buddy literally said yes in less than 15 minutes. They ended up closing on the park. They hired an on-site manager, an experienced guy who handles the day-to-day, who actually loves to do this. This is all this guy does, is operate RV parks. He collects the rents, handles the tenant complaints, coordinates repairs, costs them about 20 grand a year already baked into the numbers because, again, the person that owned it before them already had management in place. This was already underwritten into this deal. My guy, he spends about 5 hours a month on this, reviewing the manager's report, approving big expenses, and talking strategy. That's it. 3 years later, the property is worth 22% more than when they bought it. They've raised the rent twice, and the profit is up to 80 grand a year. 40 for him, 40 for his joint venture partner. He almost passed on this, guys, because RV parks felt unfamiliar and because he didn't realize you could partner up and hire somebody to do the things that you don't know how to do. That's the whole reason this asset class is still cheap. Most investors won't even look at it. And most don't realize you can split the deal as many ways as you want with people that you trust. Tonight, you're getting why they should. And the three ways anyone can get in, whether you have 300 grand by yourself or you partner up like he did, or you're working with 25. None of those things matter. I told you guys last week, do not let limitations that you think are limitations define you. Comment yes below if you've ever said no to something that scared you and later wished you said yes. Half of you guys, I'm sure this has happened because it's happened to me before. And again, guys, I only can see the live comments on YouTube. I cannot see anything from LinkedIn or Facebook at this time. All right. So here's the deal. RV parks are the most overlooked, underpriced, highest cash flowing real estate in America right now. 3 reasons why this is true. Number one, the money, it's just better. For every dollar that you put in an RV park, it pays you back about 12 to 15 cents a year. Apartment buildings pay back 4 or 5 cents on the dollar. Same dollar working 3 times harder. Nobody is buying these right now, guys. 70% of RV parks in America are owned by mom and pop owners, older folks, ready to retire. They want out. And the crazy part is, y'all, most of their kids do not want these assets that they've worked so hard to keep. And the big real estate companies, the ones with billions to spend, they haven't started buying RV parks yet. The deals are too small for them. This is our window as wealth builders. The third reason, more people want them every year. Older folks retiring into RV travel. Younger people priced out of houses living the van life. Workers chasing flexible jobs. Demand has gone up every year for 15 years straight. The supply is shrinking. That's the setup. Now, let me show you exactly why the math is mathing and the 3 ways you can get in. All right, y'all. So here's the top 5 reasons that RV parks actually print cash. When you own an apartment building, you own 40 actual apartments, meaning 40 toilets, 40 kitchens, 40 AC units. Every single thing that breaks is your problem. When you own an RV park, you own 40 pads, 40 spaces. A spot is a concrete pad with a place to plug in. That's it. The tenant brings their own RV, their plumbing, their kitchen, their HVAC. When something breaks, that's their problem, not yours. How important is that when we're investing, guys? That alone cuts your costs almost in half compared to apartments. And don't get me wrong, I love investing in apartments. When I get a great apartment deal, I'm going for it. But when I can identify something that is undervalued, underused, and it's something that can build massive wealth, I'm going to tell y'all about it. Number two, your tenant stays. People who own an RV worth 40 to 60,000, sometimes 200,000, do not move that RV every single month. Moving an RV is expensive and complicated. The average RV park tenant stays 1 to 3 years. Some stay 10 years. Some stay forever. Your average apartment tenant stays less than 12 months most times. Then you have to clean it, repaint it, find new tenants, and lose rent during the turnover time. Sticky tenants equals steady, predictable money every single month. Number 3, RV parks gain tenants in a recession. This is the part that nobody talks about. When the economy gets bad, people lose houses, they sell cars, they downsize. But where do they go? A lot of them go into RVs because it's cheaper than rent, cheaper than a mortgage. Apartment buildings, vacancies go up in a recession. RV parks, wait lists get longer. This asset class actually does better when the economy gets worse. Almost nothing else in real estate works that way. Okay, so this part gets a little technical, but stay with me. Number 4, incredible tax benefits. When the government taxes you, they let you write off the cost of your stuff over time. For most rental real estate, that takes 27 and a half years. For RV parks, the roads and utility hookups and landscaping, that all writes itself off in just 15 years. Much faster depreciation benefits. That means you pay way less in the early years in taxes. If you or your spouse work in real estate full time, those tax write offs can also cancel out income from your day to day job. Active income is the highest tax income. A lot of high earning families use RV parks specifically to wipe out their tax bill. How many of y'all want a $0 tax bill? That's what I'm working towards, and that's what I'm going to help you do. We'll get into how that works in the 90-day cash flow plan if it applies to you. Number 5, the big money guys are not in our space yet. The huge real estate companies skip RV parks because a $2 million park is too small for their portfolio. They usually want deals that are 50 million or more. So there's almost no competition pushing prices up. That's about to change in the next 5 years. Prices are going to go up, which means anyone who buys now captures the appreciation on the way up. How many of you guys have purchased in markets that were down, or and then an Amazon or a Google came and your property value shot up? Anybody living near Oxon Hill before MGM got there? Your property value shot up overnight just from being in the right location at the right time. This is the same kind of thing that's about to happen. That's free money on top of the money that you're collecting every month. If you're still with me, drop a fire emoji in the chat and in the comments below. The next part is where it gets real. I'm about to give you the 3 ways you can actually invest in an RV park, whether you have 300 grand to deploy or you're working with 25. So stay locked in. All right, y'all, let me check the chat before I go any further. What up, Lamont? Huntington, Maryland in the building. Where y'all at? All right, y'all. Are you guys ready to hear about the 3 ways you can invest in RV parks? Way number 1, own the park yourself, big baller. For people who want to be actively involved, you need about 300,000 to 500,000 in cash to start. That covers your down payment and closing costs on a 1.5 to $2 million park. You buy it, you run it, or hire somebody to handle the day-to-day yourself. The rent comes to you, everything is yours. Maximum profit, full control, all the tax benefits are yours. The only hard part is you need a lot of money to get started. And if you really want to maximize, you're the operator, meaning it's very time consuming, and there's a lot of responsibility. This is the play if you've already got rental properties, you're comfortable making important decisions, and you want your first asset, and you want your first bigger asset in your portfolio. All right. The second way you can invest in RV parks. Invest in someone else's deal. For people who want to be hands off, you need around 50 to 100,000 to get in. Here's how it works. Someone else, we call them sponsors or operators, finds the park, raises money from a group of investors. In return, you get to be completely passive, and that operator runs the day-to-day things for you and just pays you out as you all have agreed to, whether that be monthly, quarterly, and you also get paid when the property or the RV park is sold or refinanced. They send you a check and you get to collect it without doing the heavy lifting. At the end of usually 5 to 7 years, they're going to sell or refinance to get the money out of the deal. The good thing is you don't have to do anything. A pro is running it for you. You get to earn while you learn and see exactly what the profits and losses and all of those things are. The hard thing is you give up control, trusting whoever runs it, lower profit than owning it yourself. This is the play if you have a great day job and you want real estate working for you without becoming a second job. Okay? The third way, be a capital partner for people who are in between. So you need around 25,000 to 100,000 as a capital partner. This is what we do in our company. We partner with experienced operators we've personally vetted out. Due diligence is imperative. Due diligence is important. All of the properties that I own are with partners, with people who have experience, with people who have already done the things that I want to do, so that I don't have to wait years to learn something new. All I have to do is be great at due diligence and checking people out, and making sure that they have already done these things for X amount of years. I've taken X amount of properties all the way through the full 7 year cycle. Very extensive due diligence. However, you want to be with pros when you're investing in new asset classes. When we put a deal together, our capital partners come in for specific terms. Sometimes they get paid before we do, before anyone else. That's called a preferred return. Sometimes they get part of the profits when we sell, and sometimes they come in as an active partner that participates in the loss and the upside. But it's a bigger risk for a much bigger reward. So good things here. Lower minimum than the bigger deals. You know us, we show every number. There are no hidden costs. Hard thing, it's only available when we have a live deal. It's not always open. So if we have a deal and we may have 8 to 10 available slots, once they're gone until we vetted out another great opportunity. So our deals are not coming every week. Our deals come when we rate a deal a 9 out of 10. I can tell you guys, I say no to a lot of stuff. I say no. Deals come across my desk every single day. And it's very rare that I say, this is a thumbs up. This is something that I trust my investors to join me in. And I think that you're a great candidate, a great fit for us to partner with. So just know that the due diligence process and the amount of great deals out of the deals you see a day is very slim. Okay. So right now, guys, comment one word below. Either you want to own an RV park, type own if you want to own. Either you want to invest in your first park, type invest if you're looking to be a silent partner. And then type partner if you want to partner up and go ahead and take down a park. Just one word, own, invest, or partner. Tell me which one fits you. I'll respond to every comment within the next 24 hours. Now, y'all know I can't end this talk without talking about the traps, the things that kill the deal, because when people only tell you the good, there's definitely got to be some ugly hidden in there. We're going to get to the ugly. Real talk, y'all. When we bring investors into our deals, we share the risk before they put a dollar in. Same standard tonight. The 6 traps that you need to avoid. Trap number 1, buying a vacation park thinking it's a real investment. Some RV parks are seasonal. They only make money 6 months out of a year. The numbers look amazing on a summer report. Then winter hits and you like, where everybody at? Always buy parks where people stay year round, especially if you're just starting out. Now, big operators that own these assets, that have huge teams and infrastructures, they can float a park that's seasonal. But if this is your first park, you're a newer investor, it makes no sense to buy a seasonal asset and think that you can budget through the remaining years and really get through it. That's just a risk you shouldn't take. Trap number 2, parks that own the RVs. Some parks own a few RVs themselves and rent them out like hotel rooms. Those RVs go down in value every single year. They cost you money. Stick to parks where every RV belongs to the tenant. You want spots, not units. How many of you guys know people and just watch things from way back in the day? The most wealthy people were landlords. They owned and rented out the land. Very low maintenance. Think about maintenance when you're investing in assets. Trap number 3, bad plumbing and electrical. Big ticket items. The plumbing under the park, the electrical wiring, the water lines, if any of that is old or broken. Fixing it can cost over $200,000. Get a pro to inspect everything before you buy. Back to due diligence, y'all. You cannot skip or rush through due diligence, and never be afraid to walk away from a deal. I don't care if it's the day before closing. Don't let nobody play with you. Trap number 4, wrong location. RV parks need to be near jobs and highways. military base, a hospital, an oil field, a farming area, or near a real destination like a national park, the ocean, a lake, a ski mountain. Not random small towns. People go where there's a reason to be, and people want convenience. Make sure it's close to a major road or highway where they can get off and they're right at your park. They're not having to drive 2 hours off the road to find you. Okay. Trap number 5, bad loan terms. If the seller is letting you finance through them, watch out for balloon payments. A big payment due all at once in 5 or 7 years. If interest rates go up, you're stuck. Always negotiate for longer terms for protection. This is why we use creative finance when we're taking down these big assets, because it gives us room to stabilize the park, to get it up and running well before we're starting to make these really big payments. Trap number 6, the operator has no skin in the game. If you're investing in someone else's deal and that person has no money of their own in it, walk away. If it goes bad, they have nothing to lose. We require operators to have their own money in every deal that we invest in. Avoid these 6, and RV parks are one of the most predictable income plays in real estate. Hit any of these and you're just guessing. Okay? So RV parks beat apartment buildings for a regular person's first bigger real estate deal. Comment and prove me wrong below, and I want to see what you guys have to say about it, because I'm here to hear your thoughts. Here's why I believe that what I'm saying is correct about RV parks being better than apartments when it comes to cash flow and flexibility. 40-pad RV park outside a mid-Atlantic military base, year-round demand because the base has people coming and going constantly. At a $1.2 million purchase price with 300 down, 450 a spot, 30 out of 40 rented, your money coming in is about $194,000 a year over the 12 months at just 36 spots taken and 4 vacant. Your money going out for running the park through utilities, insurance, on-site management, taxes, and repairs is about $73,000 a year. Money left after running costs is about 121 grand. And then if you have a mortgage on the park, say a $900,000 loan, that comes out to about 71,000 a year. The profit in your pocket conservatively is about 50,000 a year on a $300,000 down, which is a 16.5% return for you guys in cash on year one. If you put that same money down on an apartment building, you'd maybe see 12,000 to 15,000 in your pocket. And that's a maybe. That's if everything goes right. 3 years later, that RV park is going to be paying about 80,000 a year, and the property is worth 1.5 million instead of 1.2. That's the play. The math does not lie, y'all. And I'm sure there are some multifamily apartment buildings that do really great, but I'm talking about standard numbers, the averages. That's what I'm pulling from, is averages, guys. If you have an apartment building that's doing extremely well, please share exactly what you're doing differently in the comments. If you have an RV park that is severely underperforming, put that in the comments too, y'all. All right. So you got everything I have to give for today. RV parks make money because the math is better. Nobody's buying them yet. More people want them every year. The taxes are great, and the big guys haven't moved in. You know the 3 ways to get in: own it, invest in someone else's, or be a capital partner. You now know the 6 traps to avoid. Right now in the chat and in the comments, tell me where you fit. Give me one word: own, invest, partner. You can even say not yet. That's 2 words. Be honest. I'm here for every single answer. So here's what I built for you guys. The 90-day cash flow plan will help you identify what assets you should be investing in or what you should not be doing right now based on exactly where you are. We do a deep dive on everything that you have: debt, income, assets, liabilities. And we map out the best and quickest ways for you to make cash flow in the next 90 days. So if that's something that you need, the link is in the description. It's not for everybody, but if you're looking to invest or you want to get on track to become an investor at some point, whether it's with your money or other people's money, you go ahead and book your cash flow plan so that you can start making those moves and getting in position to win. If you already passed the cash flow plan stage, big baller, if you're building a portfolio, deploying real money and doing it seriously, Elite Path to Freedom applications are open. That is my private mentorship. And you can come in on a monthly basis or you can pay for your full 12 months. And I'm in your corner to help you build and scale your portfolio. Don't apply unless it's a real fit. We read every single application. And again, only 12 people will be picked this year. So we have to be very strategic of who we're saying yes to. If you want to invest in our next RV deal and you don't need the cash flow plan, you don't want to do Elite Path to Freedom, there is an avenue for you as well. And that link will be in the description. We look forward to partnering with you again if it's a good fit. We have a couple of minutes for questions. So if you have any questions, feel free to drop them in the chat. I have a few here that I'm going to cover that I think will probably come up after people watch this replay. How much work is owning an RV park? If you hire an on-site manager, your involvement is maybe 5 to 10 hours a month. Reviewing reports, approving expenses. If you try to run it yourself, it can become a part-time job. What kind of loan do I get for an RV park? The most common is the SBA loan, the Small Business Administration loan. They give you 25 years to pay it back, and you only need 10 to 25% down. Some regular banks will lend on it, and a lot of sellers will let you pay them directly over time. RV parks are perfect for seller financing, guys. Don't be afraid to have the conversation. If you're afraid to have that conversation, call your girl. I will help you. Can I buy an RV park in a different state from where I live? Yes, yes, and yes. Half of you guys live in places that you should not be buying RV parks in. The best parks aren't in the big cities. Travel to inspect it. Hire someone local to manage it. Visit every few months. Out-of-state ownership is normal for this kind of investment in this asset class. What's the worst RV park horror story you've seen? A first-time investor bought a seasonal park. It was supposed to be pretty much fully occupied. There were a ton of vacancies. The due diligence was not conducted properly, and they pretty much almost went bankrupt trying to make this work and lost a lot of their money and other people's monies, which I don't recommend. And guys, I'm going to keep it real with you. There is risk involved. Everything that you decide to do, make sure you have a team of people you trust, your CPA, your attorney, review these things. Take your time understanding what you're doing before just jumping in and say, hey, I got my first deal. Is now the right time to buy? Yes, if the numbers work, it's always the right time to buy. We're at the front edge of big money discovering this asset class. 5 years from now, prices will be through the roof. Easy deals will be gone. And the next 24 to 36 months is our window of opportunity. Last 60 seconds, so listen closely. RV parks are the asset class hiding in plain sight. The math is mathing. Nobody's buying them yet. More people want them every year. The taxes are amazing. The big money guys haven't shown up. The map is yours now. Before you click off, comment your biggest question about RV parks below. The top 3 questions get a video reply next week, and I'm not playing. I read every single comment. If you got value from tonight, share this with somebody who needs to see it. Subscribe so you don't miss next Wednesday. We're going deep on capital deployment. How I'd actually deploy 100,000, 500,000, or 1 million today, and you do not want to miss it. Get into that free Wealth Builders community. I don't want to have to tell you again next week and you're still not in there. Same time, same place, 7:30 p.m. East. Keep building wealth.